to continue with your EPS here. So hopefully that you already read the notes and then going to discuss. We need to rush a little bit rushing now because we have another 3 more topics here. Okay, hopefully that we're able to finish that one before your second test. Okay, so I'm going to look at we're able to finish, but I'm still searching for time for discussions, discuss on your tutorials. Yeah? Hopefully that we have time for that one. Yeah? Okay, so we're going to proceed with the earning per shares. So for earning per shares, the one that you have here. Okay, just want to have. Okay, for earning per shares, only 2 things. Actually, the items earning per share is on the face of your income statement. So you're going to find there is an earning per share. So the learning outcome of what we expect from this topic, you know how to calculate the earning per share. So sometimes they call this one as a basic earning per shares. Okay, and then the other one is a diluted earning per shares. Okay, later on we're going to look at what's the difference between basic earning per shares and a diluted earning per shares. Okay, standard that we refer to here is 133 earning per shares. Okay, the standard became effective in the year 2012. Okay, it's defined the earning per share is the amount of profit attributable to the each equity share. So each equity share is referred to the ordinary shares. So how much the amount that we can returns as a return to the investor. So the investor need to know information about the EPS here because they use this information to evaluate and compare the performance of the company. So means that company with a higher EPS amount is considered company that has a more profit. More profit means that there are goods in performance. Okay, so they use this information to compare between the company, use the EPS to compare the performance of the company. And then this EPS also used to calculate for the price earning ratio. If you still remember, the PE ratio is calculated as equals to the market value divided per share. So this one, the PE ratio is a standard to show the market indicator performance of in the market. Okay, this ratio only used to value the shares of the company by variety of investment, either they want to buy a share, merger or acquisition. So the company also use these kinds of information about the EPS here for the purpose of investment decision, either want to buy new shares, merger, and also for the purpose of acquisition. So that is the usefulness or the advantage of having the EPS. Okay, this EPS is applied for enterprise whose ordinary shares or potential ordinary shares are publicly traded. So this standard was applicable to the company that are publicly traded. So means that this is a listed company. So this listed company need to use this standard, need to apply this standard. And then the enterprise, they are in the process. If you are in the process of issuing ordinary share or POS in the public security market, so you need to apply this standard also, the MFRS 133. Yeah? Okay, so the earning per share say for those as applicable for those company are publicly traded. So they need to disclose earning per share in accordance with the standard 133. When both parent and consolidated financial statement are presented, only EPS on the basic consolidated need to be presented. So you have information about the group, you have information about the company. So the information about the EPS are going to be present under group sections. For the enterprise which shares are not publicly traded, so this is not this is unlisted company. So for unlisted company, they are not required to disclose the earning per share. Not required to disclose earning per share. But if the company want to disclose its earning per share, the calculation and disclosure need to follow the standards. Okay, how to disclose, how to calculate here, and also the disclosure here need to follow the standards. Okay, so the EPS information is only need to disclose by the company that are publicly listed. Well, are not publicly listed, they are not required to disclose the EPS. But if the company tend to disclose the EPS, they need to follow the way of calculation and disclosure as required by the standard 133. Yeah? Okay. So the presentations on the financial statement is going to be present on the face of the income statement. So going to present in the income statement sections, and then in the income statement we're going to have both basic earning per shares and then diluted earning per share. Later on, we're going to look at what's the difference between basic earning per share and then a diluted earning per share. So even if the amount is a negative, even the amount is negative, we still need to present the both basic and diluted earning per share. So, okay, for a basic earning per share here, for a company with a simple capital structures, okay, maybe they're going to have only one class of ordinary shares. They will need to present, okay, for the simple company, they should present by the company that has no potential ordinary share, there is no outstanding commitment regarding share capital such as convertible security options and warrants. So a company with a simple capital structure means that there is no POS. POS here is referred to that this is item of POS. Potential ordinary share means that this kind of POS here, for example, convertible security options and warrant, they give the option to convert, okay, to convert POS to the ordinary share. If the company do not have this one, do not have the outstanding commitment to calculate earning per share, is very simple. Okay, you just use profit after tax attributable to the ordinary shareholders of the parents. So of the parents here is only profit that we're going to look at here. Is if you remember that in your consolidated income statement, you're going to have profit, again net profit. So net profit going to have the elements to parent and also the element to the NCI. So now going to look at only to the parent portions, the parents portions only. So profit after tax of parents, portion to the parent, minus a preferred dividend. So this preferred dividend need to after tax, because this profit is already after tax. Divide by number of shares outstanding. So the profit after tax attribute to the ordinary shares of the parent should be profit after tax minus the NCI. So it means that the total profit need to minus the NCI, or we're going to look at here is profit to parents only. To parents. So this is what we have. So profit here is only profit to parents. So this is a example that we have here. Okay, profit after tax attributable to the equity holders of the parent. So this is a profit only to parent here is 3 million, and then the NCI here is 1 million. So in this case, it's already have a portion for profit. So this profit we have for parent is 3, and then for the NCI we have 1. Actually, the profit here is equal to 4. So we only need to use this information. Okay, the shares capital here is 10 million. So to calculate the basic earning per shares, the profit to parents divided by number of shares. So the profit of parents, you have 3 million divided by 10 million. So we're going to have here is equal to 0.3 or 30 cents. So this one is to calculate the basic earning per shares. Simple. Profit to parent divided by number of shares. Okay, so we have to show about shares. Okay, preference shares here is the shares that enjoy, okay, the holders are going to enjoy two preference right. They're going to enjoy a dividend at a fixed rate. Okay, there is a fixed amount of the dividend on those shares before any dividends of the equity shares. So means that when they have a profit, the profit need to pay a dividends to a preference shares, and that if there is a remaining, then they're going to pay a dividend for the ordinary shares. So means that the preference shares going to have a priority to receive a dividend. Another priority that are entitled for a preference shares here is they going to receive a refunds of capital. So refund of capital in the case of liquidations or winding up here. So preference shares going to receive the refunds of capital first, and then if there is a balance, they're going to pay to the ordinary shares. So they have two types of preference here in terms of a dividend and also in terms of the returns or refund, returns or refunds. Okay, so for preference shares, we have two types of preference shares. We have cumulative and non-cumulative preference shares. Okay, for non-cumulative preference shares, okay, is shares that are those type of preference share which has a right to get a fixed rate of dividend. They're going to entitle for a fixed rate dividend out of the profit of a current year only. Okay, for a non-cumulative year, they entitled for a fixed rate of dividend in a current year. They are not carried to the right to receive a rise in dividends. They are entitled only for a current year dividend. They cannot carry the dividends to the next year. So that one is a non-cumulative. Okay. Cumulative preference shares, the unpaid dividends of a preference shares are treated as a rest and are carried forward to a subsequent year. Then such preference shares are known as a cumulative preference share. So you have two types here, cumulative and non-cumulative. Okay, so non for cumulative, they're going to have dividends for the current year and also as a prior year. Let's say the prior year there's no dividend paid, so we come to the next year. Let's say the total dividends here is 1,000. Okay, for a current year, and then a prior year also 1,000. So let's say in the year 2021, 2020, let's say there is no profit. So no profit means that no dividend paid. So no dividend paid in the year prior year, this amount can be carried to the year 2021. Let's assume that in the year 2021, there is a profit. So in the year 2021, the preference share is going to receive 2,000 as a dividend. But for the non-cumulative year, let's say the current year is 1, the prior year is 1 also. But for the non-cumulative, they are not entitled for a previous year. They only entitled for a current year. So they only have 1,000. So this is example of a cumulative and non-cumulative. Cumulative means that you can have dividends in arrears, but for non-cumulative, there is no dividend in arrears. Okay, so this is what you have for our preference dividend. So we're going to look at here, the profit after tax is 10 million. Preference dividend is 700. So 700 here is already amount here. The dividends that you have, there's no information. Okay, give you information here. Okay, preference dividends, you have 10%. 10% preference dividend is 10% here in terms of the rate of the dividends. Okay, number of share is 10 million, yeah, 10 million. So in terms of dividend, they're going to receive about 1 million, yeah. They're going to receive a dividends of 1 million, yeah. So the dividends is 1 million. So but this dividend need to be net after tax. So net after tax here, 1 million times with 0.7, yeah, because the tax rate here is 30%. So you're going to have 700 cents. Okay, and then the shares capital here is 100 million. Yeah? So this is the profit, this is a preference share. So to calculate basic and per shares here is a profit. Need to minus a preference shares dividends. Preference shares dividend is 700 and then divide by number of ordinary shares. So 100 million. So you're going to have 0.093 or 9.3 cents. Okay, so if the preference shares are cumulative, the full amount of preference dividend, whether or not paid, should be deducted. Whether or not paid should be deducted. So be careful with this one. Okay, let's say in the year 2020, there is no dividend paid. No dividend paid, but they only declare. Okay, declare here, so means that no paid, but declare, but you need to minus from the profit. Yeah? Okay, whether or not paid should be deducted. Okay, also deduction is limited to the stated amount. So stated amount in this case here based on the percentage of the dividends, 10%. Yeah. So in respective of the amount paid, in this case is 700. Because this, if you calculate here, the dividend that we need to pay here is 1 million, but that 1 million should be net after tax. Yeah. Okay, so even though, be careful with the cumulative here, even though it's not paid, but said that they only declare but not paid, so that amount need to be minus. Okay. For accumulative, but if that one is Non-cumulative, you don't have to minus that one. Yeah? For a non-cumulative preference shares, the company only paid 8% preference shares. So it is an example of 8% preference shares. So assuming that preference shares here is 8% times 10 million. So in terms of the number of unit, and then time with 70% here is the tax rate after the tax. So you're going to have 560. So the preference shares here is one the company paid, then you're going to minus it. So 10 minus 560 divided by 100, so you're going to have 94 cents. Okay, that is what you have for a preference dividends. Be careful with the preference dividend. Look at whether that one is cumulative or non-cumulative. Cumulative, declare, paid or not paid, you need to minus. If that one is for a non-cumulative, only paid, then we're going to minus from the net income. Okay, the other things that we need to, because there are two things that are important for earning per share base EPS here. We need to know about the earning, and then we need to know about the number of share, because the earning per share here is earning divided by ordinary shares. So the effect of the earnings here is effect in terms of the dividends of preference shares. Dividends on preference shares. So that is the effect to the earnings. So the other items that we need to consider here is about the number of ordinary shares. Okay, for number of ordinary share, we are using a weighted average number. So weighted average number of shares outstanding during the year. Outstanding means that available during that year. So weighted average here, because we need to proportion with the period. So that's why we are using the weighted average. Later I'm going to look at an example about this one. Okay, so there will be a changes in the number of share during the year with a consideration and then without a consideration. So number of share, maybe there is a changes of number of share where we have two type of changes here, whether that one is with consideration and without consideration. With consideration means that there is a inflow and outflow. Inflow of net asset, inflow of net asset, inflow or outflow. You need to minus asset, or simple one, inflow of cash, only involve cash. Without consideration means that there is no inflow or outflow of net asset. Means that there is no cash involved. Okay, so need two types here, changes in the number portion with or without consideration. Okay, so the changes with the considerations here. For with considerations, we only have two types here. The new share, okay, there is changes in the resources. They're going to affect the increase or decrease in the net asset. So you have two types here. Either that one is a new issue, new shares issue for cash, new shares issue for cash here. Cash going to be increased. And then the number of ordinary shares also going to be increased. The journal entries here, debit cash and then credit ordinary shares. The other one is a share buyback. Share buyback here is a company buy back its own shares. Its own shares. Okay, when it buy back its own shares, okay, cash going to be reduced, and then ordinary shares also going to be reduced. So we're going to debit ordinary shares and then credit cash. So this is one we have share buyback. So share buybacks here you need to minus it because you're going to reduce the number of shares. Okay, number of ordinary share adjusted for a new shares issue and share buyback on the time based on proportionate basis. So proportionate basis here means that you need to time with the period. So you need to look at when you issue a new share, when you make a share buyback. So we need to time that one with a period proportionate basis. Okay, so we try to look at examples here with the considerations. With consideration, remember that there is a cash involved here, okay? Or inflow and outflow of net asset. Yeah. Okay, so during the year 2018, number of ordinary shares, so this is what you have on 1st of January. Beginning balance here, you have 3,000, okay, 3,000 of shares. And then the new issue for cash here, so going to increase a debit cash, credit, ordinary shares. So we're going to increase the number of shares, another 1,200. But you need to be careful with the date because you are using the proportionate basis here. Okay, and then on the 1st of October, there is a share buyback. Share buyback here, debit, ordinary share, credit, cash. So number of ordinary shares going to be reduced. So we need to minus this one. But again, we need to look at the dates here because we're going to proportionate based on periods here. Okay, the net profit for the year 2018 was 1,600, and then preference shares dividend declared by Mawar here was 270. So you're going to find the earnings here. So the net profit here need to minus a preference shares. Then we're going to have a profit attributable to ordinary shares. So we need to calculate the earning per share because the earning per share here is only how much return that we can pay to the ordinary shares. Okay, so we're going to look at this one, examples here. So the earnings that we have here, the profit that we have here, earnings or profit to ordinary shares. So 1,600 is the profit minus a preference dividend. So we have 1,330. So we are done for the first one, the earnings. So remember that your basic earning per share here is the profit divided by ordinary shares, weighted average ordinary shares. So weighted average ordinary shares, we need to calculate this one. Yeah? Okay, so we have two methods to calculate this one. So the first one, we're going to have here. Let's finish with this one. Yeah? Okay. So weighted average. So this is the shares that we have here. We have here on 1st of January, going to have 3,000. Sorry, 3,000 here. And then on 1st of July, going to have another 1,200, a new issue. Okay, new. And then on 1st of October, we have 400 here, is share buyback. Yeah? Okay, so we're going to find the weighted average. So we're going to have here on 1st of January, means that until the end, is going to have the existing here is 3,000. So 3,000 here actually times with 12 over 12 because you hold from the beginning of the year until the end of the year. And then the new issue here, the new issue was on 1st of July. So 1st of July, starting from July until 31st December, the company have that shares. So you need to time with 6 over 12. Okay, so you're going to have here is 600 here. It is 600. 1 by 2, 1 over 2. Okay, you have 600 here, and then this one, 400 here is a share buyback. Share buyback here, you have 400. So 400 here, time with 3 over 12, because starting from 1st of October until 31st December, where there is a reducing in your shares capital because there is a share buyback. So that's why we minus. Remember that new issue plus share buyback, we have to minus here, so minus 100. So you're going to have 8,500. So that is your weighted average number of shares. So you're going to have here divide by 133 is your profit, and then divide by 3,500. So you're going to have 0.38. So another formula to calculate this one, or another method to calculate this one. So you need to look at here, starting from 1st of January. 1st of January until 1st of July, you only have 3,000 unit of share. So 3,000 unit of share times with 6 over 12. Okay, starting 1st of July until 1st of October, the number of share become 4,200. 3,000 plus another 1,200. So you're going to have 4,200. Okay, the period only have July, August, September. Okay. So you have 3 months, 3 months times 3 over 12. And then starting from 1st of October until 31st December, another 3 months, the share that you have here is only 3,800. 4,200 minus 400 for the share buyback. So you're going to have 3,800. So you're going to time with 3 over 12. At the end, you're going to have 3.5, the same thing. So either you can use this method or you can use this method, either one, to calculate the weighted average number of shares. Okay, so we proceed with the next one. This one is with a consideration. So for with considerations, you only have two types, a new issue and also the share buyback. Yeah? Share buyback going to reduce cash, new and also reduce your ordinary shares. In terms of new issue, increase cash, increase your shares capitals. Okay. Other ones we have without consideration. So this one you have to be careful without considerations. Okay, so without consideration means that there is no changes in the resources. Okay, no changes in resources means that there is no increase or decrease in the net assets. So we have four types here: a bonus issue, a share split, and then consolidations of shares, or sometimes we call as a reverse share split. Okay, and then the next one you have a right issue. So we have four types for the BOS. Okay. Okay, with considerations only two, which is a new issue. Okay, and then the other one is share buyback. Without considerations, we have four types here. Okay, bonus, share split, consolidations, and right issue. Number of ordinary shares, so be careful with this one. Yeah? Number of ordinary shares are adjusted as if the events had occurred at the beginning of the earliest periods reported. Earliest period reported. So we assume that without consideration, either the one is a bonus issue, share split, consideration, or right issue has been happened or have been occur at the beginning of the earliest reporting period. So earliest reporting period, you need to look at how many years is given in that information. Okay, so to look at here, the first one is a bonus issue. So bonus issue here is also known as a scrip issue or a capitalization issue. Is it offer a free? It's offer a free additional shares to existing shareholders. Okay, this bonus issue here is only offered to the existing shareholder. The company may decide to distribute a further share as alternative of increasing a dividend payout. So most of the time, the bonus issue here is given as a dividend. So remember that the dividends here, it can be dividend in a cash or it may be a dividend in shares. So a dividend in share here is considered as a bonus. Okay, given to the free additional share to the existing shareholders. Okay, for example, say a company may give one bonus share to the every 5 shares. So means that when you have 5 shares, you are entitled for one bonus. Okay, the number of ordinary shares to be retroactively adjusted. So retroactively adjusted means that it's going to affect the current year plus a prior year for the effect of the bonus issue. The number of ordinary shares going to be affected for the current year or also a previous year. Okay, so I'm going to have here for previous year earning per share also be adjusted as is the bonus issue was made in the first day of a previous year. So we assume that the first day of the previous year the effect to the earning per share. Yeah? Okay. So we just proceed. Hopefully that is be okay for. Okay, so proceed with the next one. If the new issue during the year, the bonus share would be assumed to have been issued at the dates of the issuance. If a new share was issued during the year, the bonus share should be assumed that have been issued on the dates of the issuance. So you need to look at if the bonus new issue. Okay, you need to look at the dates when the bonus shares. If there is a new issue, okay, new issue, let's say on 1st of April, okay, and then the bonus was announced on 1st of July. So this new issue entitled for a bonus. They're going to receive a bonus. Okay, let's say the new issue, okay, new issue was on 1st of October. Bonus was declared on 1st of June. So this new issue are not entitled for a bonus, because once the bonus, at the time when the bonus was announced, this new issue has not yet exist, because this bonus is only given to the existing shareholders. So you need to be careful with the date. When is the new issue, and then where is the bonus? If the new issue is before the bonus announced, the new issue entitled for the bonus. If the new issue is after the bonus announced, so the new issue not entitled for a bonus. Okay. What is it okay now? Okay, so problem with the slide, isn't it? So which slide that you are having now? Is it the same slide which I'm showing with you, discuss with you now? What? Is it the same slide? Okay, so we proceed now. This one is a new issue relate with the bonus issue. So the bonus issue should be just retroactive, means that the current year and also a previous year. But be careful with the new issue. If the new issue was announced is already issued before the bonus announced, is entitled. But if the new issue is after the bonus announced, it's not entitled for a bonus. Okay. Okay, we try to look at example 2 here. So example 2, the reporting year that we have here is year 2017 and year 2018. So year 2018 here is a current year, and year 2017 is a prior year. So you have net profit 6, and then the net profit in the year 2018 is 15. Ordinary share outstanding until 31st August. So the number of share that you have until 31st August here is 20,000. Okay, now on 1st of September 2018, 2 ordinary share for each one ordinary share outstanding. Yeah, so you are giving a bonus for 1 ordinary share entitled for 2 bonus. Okay, 1 ordinary share entitled for 2 bonus. So you need to calculate the basics earning per shares and also the adjusted. Okay, the original earning per share and also the adjusted. Adjusted here is after the bonus. Okay, so calculate the EPS for the year 2018 year, because this is a current year, the date when the current year when the bonus was announced. The adjusted here because the bonus was announced in the year 2018 is going to be affect the year 2017 because it's affect retroactively. Yeah. Okay, so now this one unit of share entitled for 2 bonus. Okay, so number of bonus that we have here is equals to 20 times with 2, because 1 shares entitled for 2 bonus. So number of bonus here become 20, 40. Yeah? 20 is the existing share time with 2 here is a bonus. So we're going to have 40. So EPS for the year 2018 here is a net profit. Okay, profit, net income divided by number of ordinary shares. So profit that you have here is 15 divided by 20 here is from the existing plus 40 here is from a bonus. So altogether you're going to have 60. Yeah? So 15 divided by 60. Okay. So you're going to have here is 25 cents. Yeah? Okay, and then for this one is the year 2018 here, or 15 divided by 20 times 3. 3, where to get this 3? 1 is the existing plus 2 from bonus. So you're going to have number of shares going to increase by 3. Yeah? Okay. So a bit lacking. Okay. So what you have now is example 2. But you can note with you, isn't it? Can you refer to your notes? I don't know how to adjust this one. I just present what you have here. Is it okay, Pua? You proceed with your notes. You proceed with the note. You have a note with you. So just refer to the example 2. Is it okay? Why? Is it okay there? Okay, so this is what you have. So now I think that you can see that one. Later I'm going to provide you with the recorded one. Yeah, hopefully that is synchronized. So you're going to have the basics earning per share. This is a profit. So the number of shares that you have here going to increase by 60. Yeah, okay, 20 plus another 40 from a bonus. So you're going to have 25 cents. So another way to calculate here is 1 plus 3. 1 come from the existing. Sorry, 1 plus 2. 2 is come from the bonus. Yeah? Okay, so for the year 2017, we need to make an adjustment. Yeah? Adjustments here because now the number of shares become 60. Yeah? Before this, the number of shares here is only 20. But now, since the bonus, we need to prepare a adjusted. Okay, we assume that the bonus is already given in a earliest year reported. So assume that in the year 2017, also the number of shares become 60. Yeah? So 60 that you have here, the number of shares here, 60. So the adjusted earning per share here would be 10 cents. Okay. So before this, the earning per share for the year 2017, if you look at here, you have 6 divided by 20. Yeah? This is the existing, and then this is adjusted. 6 divided by 20. So you're going to have here is equals to 30 cents. Okay, this one is before adjustment. This one is before adjustment. And then after the adjustments here, the shares here is only, the earning per share here is only 10 cents. Okay, the numerator for the EPS calculation for the current and prior year should be based on the new number of shares. So new number of shares here is 20 plus 40. 20 from the existing and then 40 from a bonus. So together going to have 60. Okay, so in this is the case when you issue a new share during the year. So outstanding shares that we have here is 100. Okay, assume that the financial year end is between January to December. On 1st of May 2018, so existing shares, you have 100 million, yeah, 100 million. On 1st of May, okay, 1st of May, you issue 30 new shares, 30 new shares. This is the new shares. Okay, on 1st of October 2018, issue a bonus issue of 1 to 10 bonus issue. So you're going to entitle, so 10 units of shares going to entitle 1 bonus. So 1 bonus. Okay, so look at the dates that we have here. New issue was on 1st of May. Okay, so the bonus was announced on 1st of October. So means that the new issue is earlier than the bonus. New issue is earlier than the bonus. So means that this new issue entitled for a bonus. New issue entitled for bonus. Okay. So I'm going to calculate this one, the number of shares. So the number of shares that we have here. So for the existing, we have 100. So 100 here times with 1 over 10 or divide by 10 here, you're going to have 10 million. So 100 plus 10 million. So you're going to have here, this is existing. This is a bonus element. Yeah? Okay, for the new issue. Okay, for the new issue existing, you have 30. And then time with 1 over 10, so you're going to have another 3. So for the new issue existing, you have 30 plus 3 from a bonus, so you're going to have 33. Yeah? But this new issue was on 1st of May, so you need to proportionate with the number of periods or number of months that you have here. So altogether for the existing, you're going to have 110. So 110 times with 12 over 12 here, because we have here from the beginning of the year. And then you're going to have here is 110. Okay, 110 plus, okay, plus this one you're going to have another 22. 33 here is from the new issue. Time with 8 over 12 because it's starting from May until December. Until December, you have 8 months here. So time here, we're going to have 22 here. So altogether, we're going to have 132. So this is the denominator for the year 2018. But for the year 2017, the denominator here is 110. 110 here based on the existing only. So the existing, you have 100 and then plus 10 from bonus. Okay, because the new issue here is only in the year 2018. So in the year 2017, we only have 110. Even though the bonus was issued in the year 2018, it's going to affect a prior year. Okay. So any questions up to slide 20? Okay, any questions that you have here? So we proceed. Okay, that is a new issue. Okay, the next item that we have here is a share split. Okay, for a share split here is decisions. Okay, a decision by the company board of directors. Okay, to increase the number of shares. So the effect of share splits here. So for the effect of share split, ordinary shares going to increase in terms of number of shares, and then the market value going to reduce. Okay, going to increase the number of shares outstanding. Okay, and more shares to the current, by issuing more shares to the current shareholders. So going to issue only to the existing shareholders. Okay, for example, here is 2-for-1 share split. So 2-for-1 share split, an additional share is given to each share held by shareholders. So a shareholder share split is like a bonus split, does not involve inflow of fund. It is also a retroactive adjustment. So 2-for-1 here. So 1 going to become 2. So split here. Okay, for example, here a company with 100 millions ordinary share, financial year end 31st December. On 31st August, the share split here is 1 to 2 shares, 1 to 2. So 1 share become 2. Yeah? So 1 shares become 2 here. So the denominators here is 100 million times with 2. So you're going to have 200 million. Yeah? So the denominator here for each year, for both of year 2018 and then the year for the year 2017. Yeah? They're going to affect retroactively. So one share is going to split into 2. So the number of shares here is 2 times with 100. So now it becomes 200. So share split here going to increase the number of shares, but there is no cash involved, but the market value of shares going to be reduced. Okay, the next one you have a reverse share split. So reverse share split, sometimes we call this one as a consolidations of share. Okay, a reverse share split decrease the number of shares. It's going to reduce the number of shares, and then it's going to increase the market value of the shares, the effect. Yeah. For example, here the company has the hundreds million. In the year 2018, its reverse share split by 2 into 1 share. So 2 shares become 1. Okay, 2 become 1. So for the year 2018 and the year 2017, the denominator of EPS here become 50, which is 100 divided by 2. Yeah? They're going to have 50,000. So if you look at here, the number of shares going to be reduced. The number of shares starting from 100 now become 50 only. So the number of shares has been reduced. Okay, share split, increase the number of shares, reduce the market value. But the reverse of consideration share split, considerations of shares here, going to reduce the number of shares, increase the market value. Okay. So this is what you have here. So on outstanding share is 100. On 1st of May, issue a 30,000 ordinary share. On 1st of October, okay, 1st of October 2018, issue a share split, 1 to 2 split, 1 to 2 split. So number of share at the existing you have 100, okay, and then on the new issue you have another 30. Okay, so you're going to have here, okay, the existing here 1 to 2 shares. So 1 to 2 shares here, next time with 2. So you're going to have 200 for the existing. And then for the new issues here, because the bonus issue is announced, or the share split is announced after the issuance of the new share. So this new share also entitled for a share split. So entitled for share split. So 30 million times with 2, so you're going to have 60 million, but this 60 million need to portion with a period here. Okay, so denominator for the year 2018 here is 200 times with 12 over 12 plus 60 times with 8 over 12. Yeah, so 240. But for the year 2017, the denominator here is only for the existing shares. So it's only 200. Okay, so this is example of a share split. Any questions that you have here? So this is a share split. So you need to look at the dates with a new issue. Either this one is before the share split or the bonus issue. So whether they are entitled for the share split or the bonus or not. Yeah? Now going to look at the right issue. So another things that we have here. So for the right issue here is an invitation to the existing. So they invite the existing shareholder to buy additional share at a special price. Going to offer to the existing shareholder to buy at a special price. Okay, for example, if the share of an entity are traded at 5 ringgit per share, so this is a market value of the shares, and the exercise price under the right issue is only 4 ringgit. So the exercise price, so the exercise price here will be lower than the market value. So they only offer to the existing shareholder. So it means that for every 1,000, the entity going to receive 250 shares. Under the right, they're going to receive 250 shares, but under, if they issue in a full market here, they're going to issue at 200 only. Okay, for 1,000 divided by 5. So additional 50 shares issue is deemed to be a bonus share. So in the right issue, there is elements of bonus here. So the elements of bonus here, we need to find the difference between market value and then the exercise price. So we need to find how in terms of number of shares. The difference here because of the market value. If the market value is the value to the public, if you offer to the public, they're going to offer at the price of 5 ringgit. So number of share they're going to increase here is only 200. But if they offer to the existing shareholder at the price of 4 ringgit, number of shares going to increase here is 250. So the difference between 200 and 250, that 50 here is considered as a bonus. Okay. The notionals not existing as bonus element is the right issue may be computed as equal to the difference between the market price of the shares. Call this one as a come right price. Compare with the market price of the share X right, which is the X right price. X right price is the exercise price. Exercise price. But come right price here is a market value. So the difference here is due to the difference between market value and the exercise price. Okay, come right or right, the with right allow the shareholders of the allow a shareholder of a record to subscribe to a right offering declared by a company. Owner of the shares that have a come right are able to buy the new shares. Here, when you have a right, you are able to buy the new share at the price. Okay, can I just close this one for a while? Okay, able to buy the share at a price which is lower than the current market price. Current market price. X right price is the market price that stock will be theoretically have the following to a new right issue. So you have two types here, come right, which is the market value, and then the X right, here is the exercise price. Okay, to find the right issues here, so the exercise price is often less than the fair value of the share. Therefore, when the exercise price is lower than the market value, which is the value that we're going to offer to the public, there is elements of bonus. So we need to find these elements of bonus because this bonus is related without considerations. You issue a share without considerations. Okay, to find the bonus elements here, the number of ordinary share used to be calculated basic and per share. So to need to find the number of ordinary share is the number of ordinary share. Okay, outstanding prior to the right issue time with a factor. Factor here is a right adjustment factor. So right adjustment factor. Okay, to find a right adjustment factor, there is a formula for that one. So you need to know this formula. There are many formulas for this one, for the right issue. Okay, the first one you need to find the factor. So the factor here, right adjustment factors here is calculated as a fair value immediately prior to the exercise of right divided by theoretical X right value per share. So theoretical X right value per share is a number of shares before the issuance of right time with the come price. Come price here is a market value. Okay, plus number of share issue under the right issue, time with the exercise price. And then divide by, so this is a formula for theoreticals, yeah? Divide by number of share after the right issue. So number of share after the right issue is a number of share outstanding before the right issue plus the number of the share issue in the exercise. So we're going to have combinations of the prior plus right issue. Okay, this is to find the theoretical. Once you find the theoretical as right value, we're going to find the factor, right adjustment factors. The right adjustment factor is market value divided by theoretical as right value per shares. Okay, so we try to calculate this one. Okay, and you have 3 years here, 3 reported here. So outstanding share prior to the right here is 1,500. This is a number of share before the issuance of right. Yeah? The right issue here is 1 new shares for each 5 outstanding share. So 5 outstanding share entitled for 1 new share. 1 new share, 1 right. Yeah? Exercise price is 9 ringgit and 90. The last date to exercise the right here is on 1st of May 2017. The fact okay, so the first thing you need to find how much the right issue. Right issue is said that 5 unit of existing shares entitled for 1 right issue, 1 right. Okay, so we're going to have here of 1 new shares. Okay. So you're going to have this one. So you can entitle for 5 shares. Okay, entitled for 1 right new issues. Okay, so the existing that I have here is 1,500. So 1,500 divided by 5 here. Going to divide by 5. So you're going to have 300. 300 for the right issue. Okay, so the next one we need to find for the theoretical at right value. So theoretical at right value for per shares that we have here is a formula for this one is a number of shares. Okay, number of shares. Okay, before the right, so you have 1,500 time with before right, and time with a market value. So this is a market value plus 300 here. 300 here is the number of issue and the right issue. Okay, time with a exercise price. Exercise price divide by, okay, this one is plus and then divide by number of share outstanding. Okay, before right plus right issue. Number of share outstanding is 1,500. Right issue here is 300. So we're going to have here altogether we're going to have 1 and 1.8. Okay. So the factors theoretical at right value here. So the theoretical at right value will be 14 ringgit and 15 cent. 14 ringgit and 15 cent. Okay, then from that theoreticals at right value, then you can calculate for the right adjustment factors. So right adjustment factors, the formula here is the market value divided by theoretical at right value. Theoretical at right value. So the market value is 15. Theoretical at right value here will be 14.15. Yeah? So we're going to have here is equals to 1.06. So 1.06 here is the right adjustment factor. So from that right adjustment factor, then we're going to calculate the number of shares. Number of shares outstanding here is okay. So number of shares is outstanding, the one that you have here, is equals to. Can we move back to this one? Number of shares outstanding. The formula here is a number of shares before right issue. Okay, time with a right adjustment factors. So number of share before right issue is 1,500. time with 1.06. So we're going to have here the number of shares, ordinary shares that we have here is 1,500. Okay, so we're going to have here 1,500 time with 1.06. So we're going to have 1594. Okay, we're going to have 1594. So we're going to calculate this one. So the earning per share for the year 2016 based on the originally reported before the adjustment. So you're going to have 3,200 divided by 1,500 is the existing shares. Okay, so you're going to have 2 ringgit and 30. When it comes to the adjusted share, so now the number of shares here is a shares before 1,500 here. Okay, number of shares before. Okay, before right issues time with a right adjusted factors. So you're going to have here is 1,800. Okay, so 3,200 divided by 1,800. So you're going to have here 2 ringgit and 10 cents. So compare with this one. This is the original one. This one is after the restated after the right issue. So for the year 2016, and then for year 2017, so the right was year 2017. So in the year 2017, the basics earning per shares that we're going to have here, because the right here is in the year 2017. Exercise here is on 1st of May 2017. So this is the profit. Okay, for the number of basics earning per shares that we have here, for number of ordinary shares, 1,500 time with 1.06, we're going to have here is 1,594 time with 4 over 12. So 4 over 12 here is period before exercise. This one is a before exercise. So you're going to have 4 over 12. And then this one is a period after exercise. After exercise, the number of share become 1,800. Where do you get this? 1,500 plus another 300 from the right issues. And then but the periods that we have here is starting from 1st of May. So we have another 8 months. So 1,800 times with 8 over 12. Yeah? So altogether you're going to have here become 2 ringgit and 31 cents. Okay, that is what you have for the year 2017. When you come to the year 2018, so for the year 2018, you're going to have the profit here is 5,800 times with 1 divided by 1,800. 1,800 here is now the existing shares become, okay, existing share become 1,800. 1,800, 1,500 plus another after 1st of May 2017, 1,500 plus another 300. So we're going to have 1,800. So that is what you have for the year 2017. So look at the difference here in the year 2017 and then the year 2018. 2017 before, okay, before the exercise of right, then you need to time with the factor. After the exercise of right, you don't have to time with the factor. You need to use the new value of the shares or the new ordinary shares. Okay, so any questions for the right? Any of you have a questions for the right here? The right issue, so be careful with the right issue. Can we proceed? Okay, we proceed with the next after the right issue. So proceed. Be careful with the right issue. Look at the factors that we have here. Okay. So we're going to have this one is dilute for the basic earning per share 2018 here 3.22. Okay. So now we're going to look at the diluted earning per share. So this one, starting from this one, you need to pay more attention for the diluted earning per share. Diluted earning per share means that there is a decrease or reductions in earning per share. Okay, decrease or reductions in earning per share. Okay, EPS may decrease if the equity profit, okay, just wait for a while. Okay, sorry about that one. Okay. So we're going to proceed with this one, a diluted earning per share. So diluted earning per share means that there is a decrease or reductions in earning per share. So decrease in earning per share because of the equity profit is divided by a greater number of equity shares. So the denominators has been increased. So once your denominators has been increased, so the EPS will be decreased. Okay, because the greater number of equity share can be arise because of the existing commitment include regarding shares capital such as warrant, options and convertible bonds. So this type of, we call this one as a POS, a potential ordinary shares. Okay, POS here is examples here is warrant, options and convertible security. These types of POS can be convert to ordinary share. So once you convert to the ordinary share, the number of shares going to be increasing. Okay, so the standards mentions that the commitment here is considered as a POS, potential ordinary share, which is defined as a financial instrument or other contract that may entitle its holder to the ordinary share. So means that the ordinary shares here, the holders of this commitment in the warrants, option. Later on, I'm going to explain what is warrant, options, and convertible security. Maybe the holder is these kinds of warrant, options, and convertible security going to convert their POS into ordinary shares. So once they convert this POS to ordinary shares, the number of shares going to increase. So once the number of shares going to increase, your EPS going to reduce. Okay, the diluted earning per share must be shown to indicate the potential that the current EPS may be diluted in future because of those POS. With this only expectations, what will happen to your earning per share if all the POS here convert the POS into ordinary shares. This dilution is not an actual one, but it's only a potential dilution and which may or may not occur in future. But we need to consider this one. The information about diluted earning per share is important because shareholder and investors should be make aware of the potential danger that the EPS in future may be diluted. Diluted here means that reduced if the existing POS tend to convert or exercise to ordinary share. They convert their POS into ordinary shares. So once they convert their POS to ordinary shares, the EPS going to be reduced. Okay. So proceed now with this one, the next one. Okay, diluted earning per share. So we have POS here. So POS here is either the financial instrument or others contract. Financial instrument or other contract that may entitle its holder to ordinary share. So means that the holder of POS here can convert to ordinary share. Example for POS here, you have convertible preference shares, convertible debt on loan, okay, debt on loans here, shares, warrants and option, and then employee plan, the ESOS here. Okay, so they may convert this one into the ordinary shares. So 4 types of POS. You have 4 types of POS. Okay, so once you have the effect of the POS here, you're going to effect to both here. Going to effect POS has going to have effect to the net income. Then it's going to effect to the ordinary shares also. So effect to the net income here, the net income and weighted average of shares should be adjusted. We need to adjust the net income for the effect of all dilutive potentials ordinary shares, diluted POS. We need to effect here. Okay, and then the DEPS, diluted earning per share, more looking forward and is intended to act as a warning to the existing or prospective shareholders. So the net going to effect to both the net income and also to the ordinary shares. The ordinary shares going to be increased. Net income either increase or decrease. It depends on types of POS. Okay, we look at to the dilutive and anti-dilutive. So for the diluted here, the POS may have a dilutive and also may have anti-dilutive. Dilutive here means that in decrease in the EPS, okay, from the continued operation. So to compare whether that one is a dilutive or anti-dilutive, you need to compare between basic earning per share. Let's say your basic earning per share here is RM2. And then diluted earning per share here is RM1.50. then it's considered as a dilutive. Okay, the next one, the other one, basics earning per shares and RM2, and then diluted earning per shares here is RM2.50, so it's considered as a anti-dilutive. So for the POS here to calculate that diluted earning per share, we only consider the one that as a dilutive. Anti-dilutive, we're going to exclude. Later I'm going to have example for this one. Until if you find that when you calculate here, you compare between basic and diluted. If the diluted is higher than the basic, then it considered as an anti-dilutive. So anti-dilutive need to be excluded from the calculations of diluted earning per shares. Okay, so we're going to look at the effects of the diluted POS, potential ordinary shares on the net profit. So in terms of, they're going to affect in terms of dividend recognized. This one is related with the preference share. So once your preference shares convert to the ordinary share, means that there is no dividend for preference shares. Okay, interest recognized is related with the loans, convertible loan. So once the convertible loan is converted to ordinary share, means that you don't have to pay for an interest. Okay, other changes in income or result from the conversion sale. So this one will affect if there is no income, there is no dividend for preference share, there is no interest to be paid, so the net income going to be increased. So going to affect to your net income. At the same time, okay, so we're going to look at will no longer be incurred since this dividend and the interest is no longer to be incurred. The POS is, if the POS convert into the share, the net profit going to be increased. So you don't have, because once you convert preference share to ordinary share, you don't have to pay for a dividend. So the net income going to be increased. The same thing for the interest. In computing the diluted earning per share, the earning for the period should be adjusted by adding back. So you need to add back the amount of these preference shares, dividends, and the interest, and assume that the saving of the interest on the security that convert and the dividend for the person we don't have to pay paid. So need to add back the changes and also add there is any other changes in income and expenses that would result from the conversions of a convertible security. So the effect to the earnings here or the net income here, you don't have to pay for the preference dividend, do not have to pay for the interest. So that one will increase your net income. Okay, and then for the, in terms of the ordinary shares, back to the ordinary shares. So for the ordinary shares here, the number of shares here going to increase. Okay, the number of shares going to increase. So the increase of number of shares is determined from the terms of POS. So going to increase the number of shares. Okay, and then we try to look at for the options and warrants. Okay, for options and warrants here is options given to the rights to the employee to acquire ordinary shares. Okay, this is options given to the existing employees. They're going to have a special right to acquire ordinary shares. Warrants here is related with a long-dated call option that give the holder the right to subscribe ordinary shares of a company. Normally, it's a package with a unsecured loans. This one is related with the unsecured loan. Okay, unsecured loan, or this one is related with your loans, current loan, secured loan. So give you a warrant. So let's say the holders can convert the loans into the ordinary shares. The difference between the number of shares issued under options and the number of shares that would have been issued at a fair value should be treated as an issue of ordinary share without consideration. So for the options here, there is a consideration. So options or warrant would result in the issue of ordinary share for less than a fair value, and then this one is considered as a dilutive. Okay, will result in the issue of ordinary shares less than a fair value. The fair value of ordinary shares. So remember that for the fair value of ordinary share, we're going to use the average price. We're going to use the average price during the period. So we're going to give you the fair value and also the average price. So the one that we're going to use here is the average price. Okay, we're going to treat you, we're going to give you two information, the average price and the fair value. So we're going to use the average price, not the fair value. So we're going to proceed. No adjustment made to the earning. Okay, for options and warrant, there is no effect to the net income, but there is an effect to the ordinary shares. Ordinary share will be increased, net income, no effect, because that is not related with the dividend. It's not related with the interest. No effect to the net income. It's only effect to the ordinary shares. The number of ordinary shares going to be increased. Okay. So we try to look at example 4. Maybe we're going to finish with this example 4, example 5 and 6 for the next class. Okay, this one is for Kenanga. So Kenanga net profit is 250. Weighted average of ordinary shares is 62,500. Average fair value. Okay, average fair value is 16. And then weighted average of the options here is already given here. Options here is 8,000. So 8,000 here. And then exercise price here under options here is 2 ringgit. If you look at here, the exercise price is lower. Exercise price is lower than the fair value or the market value. So there is elements of bonus. So you need to find these elements of bonus. Because only the bonus here going to affect your number of shares. Okay, so we need to calculate the basics and also the diluted. Okay, so for basic, just a number 1. Okay, so the number under the share options that given here is 8,000. So the share options given 8,000, but you need to find the bonus elements here. Okay, so the bonus elements here is the difference between market value and the exercise price. So we need to find the number of shares that have been issued at fair value. If we issue at fair value, what we can have for that one. So 8,000 times 12 divided by 16. So 8,000 here is the number of options given in terms of units. So option time with a exercise price divided by market value. So you're going to have 6,000 here. 6,000 here means that if you issue at the fair value, so issue at fair value, here we only able to issue at 6,000. But if you issue at the options here, we issue at 8,000. So the difference here, there is elements of bonuses. So elements of bonus here we call as a incremental share without consideration. So the elements of bonus here is a difference between the option. Shares under the options here is 8 minus shares under the fair value here. So we're going to have 2,000 here. So that 2,000 here is considered as a bonus issue. Okay, or another formula to calculate for this one. Okay, maybe we can use this one. This one is a simple here. Okay, the options. Okay, shares option. Okay, time with. Okay, average market value, using average market value minus the exercise price, okay, divide by exercise price, divide by average market value. Okay, so this is what you have for this one. Okay, share options time with average. We are using average, average market value minus the exercise price divide by average market value. Okay, average market. Then we're going to find this is 2,000, the same thing. So means that 2,000 here is without considerations, the one that you have here. So without the bonus elements. Okay, to calculate earning per share here, so this is your basic earning per share here. So basic earning per share here is before POS. Before convert the POS based on the basic earning per share means that without POS. Without POS. Okay, basics here 250 is a profit divided by number of shares. So number of shares that you have here is 62,500. So 62,500. So the basic earning per share here is 4 ringgit. So 4 ringgit for the basic earning per share. Then we're going to look at for the diluted earning per share. So for the diluted earning per share, remember that WOS has 2 effects. To the number of ordinary shares. Okay, so it said that for a warrant and options here, there is no effect to the net income. The income consideration. Without considerations here is number of share under option minus number of share under fair value using the issue at fair value. So we're going to have 6 here. So the incremental share without considerations here is 2. So 2,000. So number of diluted earning per share here means that diluted earning per share here is we assume that the bonus was taken. So once we assume the bonus was taken, so the POS come in ordinary share. So the POS that you have here is 2,000 plus the existing plus that already converted to the ordinary share. So we're going to have 6,450 divided with 6,450 ringgit and 88. So if you get here, whether that one is anti-dilutive here, you look at the effect of your asset. If your asset basically before the asset will dilute. I think that the next one to have, for example, and as example 6 is in the case when you have more than one POS. So remember that we have 4 types of POS for one POS. Here, which is a bonus. We have another more than one POS. Remember that you have 4. The you have a preference shares, you have a convertibles, and then you have an employee plan. So for the class, we're going to continue with this note starting from this slide. We're going to continue from this one. What happens when we have one POS? We're going to test whether they are dilutive or anti-dilutive separately. Separately means that every POS for every POS, we don't need to test for dilutive or anti-dilutive. But if you have more than one POS, so dilutive here is one means that when your diluted earning per share is lower than your basic. So for more than one POS, we're going to test for dilutive, but this time is separately. So every single POS going to test for dilutive and anti-dilutive. So we have a few steps here to calculate for the earning per incremental shares related to each of the POS. Okay, for those earning per incremental share that are higher than the net profit from the continuing operation, a control number is considered as a anti-dilutive and should be excluded. So we need to compare between earning per incremental shares compare with the base earning per shares. If that one is higher, then is considered as a anti-dilutive to be excluded. Okay, item number 3. Okay, earning per incremental share that are low and benefit from continuing operation, which is with a basic and which when there is a lower, then it considered as a dilutive. So going to include in the computations of diluted earning per share, and the lowest we will include first and so on. So for the next class, to start with this, so please read example 5 and example 6. Hopefully that by half an hour we will finish example 5 and example 6. So the next 4 minutes we're going to continue with your operating segment. So please read on the operating segment notes, example 5 and 6 together with the operating segment. We're going to continue with this slide. Earning per share when you have more than one POS. So no like for segment. Okay, I'm recorded for the tutorials 5 and tutorial 6. So the next submission here is a tutorial 6 on 6th of June. Yeah? So any questions that you have here? Any questions that you have here? So I'm going to stop sharing this one. Yeah. Any questions? If you have any questions, stop sharing this one. And then for your attendance one again. Yeah? Okay. So please read your notes. Okay. On example 5 and 6, together notes on operating segments. Okay, so any questions that you have here? Do you have questions here? Hopefully that we have some time to discuss on your tutorial, at least one question from tutorial 4 and then one question from tutorial EPS. Okay, which one that we're going to discuss? I think that we still have time. Because this coming Thursday, we're going to discuss EPS, finish with the operating, and then next Monday is public holiday. Like Thursday, we have the related party. Maybe have first 40 minutes for related party, and then we still have time to discuss for the at least questions from tutorial 5, and then next Monday for your exam, another one question from tutorial EPS, and also the mini case that one. Okay, but I'm going to provide a PowerPoint for tutorials 5. At least we have time to discuss together at least one question from tutorial 5 and tutorial 6. Okay, any questions that you have there? Any of you have a question, sir? Any questions?